Hello everyone, it is Bryan of Asante Capital Management, and today I wanted to take a few minutes to talk about market declines and how the one we're currently in fits into the broader historical context. For many, it can feel that we are always in an investment hole, trying to recoup where we were only a month or two prior. Unbelievably, it was only 2 years ago where we felt the fastest 30% drop in US equities on record. Then, the antagonist was a virus. Today, it is stubborn inflation, rising interest rates, and an unstable geopolitical environment. The reality is, this is the norm. Sudden declines are a normal part of the market cycle. They are a magnifier of collective fear. When the broad market, say the S&P 500, goes down by 10 or 20%, does that imply that the economy is also going to contract by 10 or 20%? Or that company earnings will be impaired by 10 or 20% permanently? The profound recession caused by the great financial crisis lasted 1.5 years and saw the US economy decline by 5.1%. Absolutely, company earnings collapsed for some time and the mood was dire. However, measures were put in place to stabilize the financial system, which allowed the economy to heal. In retrospect, the 49% decline of the S&P 500 was certainly an accurate gauge of the mood, but an overly negative view of the future. The chart below shows the annual performance of the S&P 500, the broad US stock market, since 1980. In 1981, the annual performance was minus 10%, while in 2013, it was plus 30%. During this 40-plus year period, the S&P 500 had an annual return of 9.4%. Importantly, this period includes multiple wars, a global pandemic, along with multiple debt, financial, and currency crises. Some good was also achieved, with absolute poverty almost being extinguished across the globe, with a relative reduction of 43 to 10%. You'll note that the S&P 500 had positive returns in 32 of 42 years. So, for every 3 years of advancement, you could expect 1 year of retrenchment. The chart makes it seem like a benign journey with only a few interruptions along the way. This would be the case if we checked our balance on December 31st and then went into a year-long hibernation. The reality is that we live day to day in the real world with all of its complexities. When we look below the surface, we get a better appreciation of how each year goes through its own cycle. While the gray bars show how the S&P 500 performed over an entire year, the red dot tells you the largest decline that took place during the same period. If we look at 1987, for instance, the year of Black Monday, the market went down by 34% at one point. But it ended the year with a 2% positive gain. Or, in 1980, when the market rose by 26%, it was down 17% at one point. The journey is a little bit more rough than was originally presented. On average, the S&P 500 sees a 14% decline each year. You could say that most years have their own bear or mini bear market. Most of the time, we tend not to notice because it recovers before the next statement, or the crisis du jour does not make it into the mainstream media. So why do so many agonize around these otherwise ordinary rhythms? Should investors not be more accustomed to them? Certainly the media doesn't help by trumpeting the world's problems and divisions, but I also think the cognitive bias called anchoring is also at work. In the realm of investing, anchoring skews us to believe that the highest portfolio value that we've achieved is the one we ought to have. dare I say, deserve to have. As our portfolio grows from 750,000 to 800,000 to 850,000, a mental ratchet locks these values in place. Our hardwiring leads us to believe that this value should not come down. I believe we'll see the anchoring effect play out in GTA real estate in the coming months. If your neighbor's home was worth $1 million in June of 2021, and then quickly rose to $1.3 million January 2022, but quickly retreated to 1.1 when interest rates rose this spring, did they lose money? Are they down? Perhaps more importantly, how do they perceive their position? It is only human to hold on to the $1.3 million value, the highest value, the anchored value. I'm not trying to gloss over the stress that these episodes cause. As I record this on May 11th, the S&P 500 is down almost 16% year to date. Compared to previous intra-year declines, it is not the softest, nor the most striking. Like before it, this retrenchment has a new storyline and a new set of villains. During times like these, we need to stick to our plan and not forget how we endured and rose from previous tough times. The truth is, to earn more than a GIC rate, we must bear this volatility.